If you own a home worth £400,000 and you've put £100,000 away in a pension, you are already sitting on more than the government will let you pass on tax-free. That is not a scare tactic. It is arithmetic, and by the 6th of April 2027, the arithmetic gets worse. Right now, every headline is chasing a new mansion tax on homes over £2 million. It is easy to read that and feel safe. A semi-detached in the Midlands or a bungalow near the coast is nowhere close to £2 million, so the story feels like someone else's problem. That is the distraction. The real threat is not a surcharge aimed at mansions. It is the frozen inheritance tax thresholds sitting quietly underneath your ordinary home, combined with a new rule that pulls your pension into your estate for the first time. Put those two together, and a completely normal household, not a wealthy one, can be looking at a bill of around £120,000 that lands on their children. I have watched families assume inheritance tax is something that happens to other people, the ones with the big house and the second property. Then they sit down, add up a modest home and a modest pension, and realize the number the government uses to decide who pays has not moved in years while house prices kept climbing. So before we get to the three moves that actually protect a normal estate, you need to see the mechanism that is doing the damage. It is not a new tax. It is a threshold that stopped moving while everything around it kept rising, and it has a name inside HMRC's own paperwork, the frozen floor. Here is the number nobody explains clearly enough. The inheritance tax nil rate band, the amount you can leave before tax kicks in, has been frozen at £325,000 since 2009, and it stays frozen until 2031. Add the residence nil rate band on top, £175,000 for passing a home to children or grandchildren, and your real threshold sits at £500,000. That sounds like a lot until you remember that average UK house prices have climbed by around 18% over the last 5 years, according to ONS figures, while that £500,000 line has not moved at all. This is called fiscal drag, and it is not an accident of bad luck. When a threshold is frozen and asset values keep rising, more ordinary households cross the line every single year without doing anything different. You do not need a mansion. You need a normal 3-bedroom house that happened to gain value the way most British homes have. Every year the threshold stays where it is, more families cross that same line for the first time, and most of them do not find out until a solicitor tells them after a death in the family. Then there is the change that turns this from uncomfortable into urgent. Right now, your pension sits outside your estate for inheritance tax purposes. From the 6th of April 2027, that changes. Unused pension pots become part of what HMRC counts when they work out your bill. Picture a fairly typical retired couple with a home worth £450,000 and a pension worth £250,000. Together that is £700,000. Subtract the £500,000 tax-free threshold and £200,000 is left exposed. Taxed at 40%, the bill comes to £80,000 straight out of what their children would have inherited. This is not a tax aimed at wealthy people with a portfolio of properties. It is a tax that catches the people who did what they were told, who paid into a workplace pension for 30 years and bought a family home instead of renting. If that description is starting to sound familiar, it is worth staying with me, because there are 3 specific moves later in this video built for exactly this kind of estate, not a millionaire's. If you are realizing your own home and pension add up closer to that £500,000 line than you thought, this is the kind of shift Arthur's UK Retirement Guide exists to track, so it is worth subscribing while we work through it. But the bill on paper is only half the story. What happens when you need to actually use some of that home's value while you are still alive? That is where a second, quieter trap is waiting, one that can cost you your pension credit before HMRC ever gets involved. Say you release £20,000 from your home through an equity release lump sum. That money does not vanish into a special protected category. As far as the Department for Work and Pensions is concerned, it becomes savings, and savings above £10,000 start eating into your pension credit straight away. Here is how the taper works. For every £500 you hold above that £10,000 disregard, the DWP assumes you are earning £1 a week from it, whether you actually are or not, and that assumed income is subtracted from what you receive. Release £20,000 in one go, and you can find your pension credit reduced to nothing, even though the real interest sitting in your bank account is a fraction of what they are assuming. The instinct a lot of people reach for is to just hide the money, move it somewhere it will not show up on a bank statement. Do not do that. It counts as deprivation of assets. The DWP can treat you as if you still have it, and it can trigger a fraud investigation on top of the benefit loss. That is not a workaround. It is a much worse problem than the one you started with. There is a legitimate structure that does the same job without the risk, a drawdown facility instead of a single lump sum. You agree the total amount with the lender in advance, but you only draw down what you need when you need it. The portion still sitting in the facility, not yet released to you, is not counted as your savings because you do not have access to it yet. Take £5,000 now. Instead of the full £20,000, leave the other £15,000 in the agreed facility, and you stay under the £10,000 disregard with room to spare. That can mean keeping full pension credit eligibility worth close to £3,900 a year, support you would otherwise have signed away for a lump sum you were not planning to spend all at once anyway. I used to think equity release was purely a last resort, something you only touched when every other option was gone. Watching how the DWP treats money you can reach against money that is simply sitting in a pre-agreed facility changed that. I was wrong to write it off as just an expensive debt product. None of this means a drawdown facility is free of cost. There is a catch buried in the interest rate that most brokers will not walk you through until you are sitting in front of the paperwork, ready to sign. Let me show you what this actually looks like with real numbers, because the trade-off only makes sense once you see both paths side by side. David is 64. Susan is 62. They live in a £400,000 home in Bristol, and they need £30,000, some of it for a new kitchen, the rest to finally clear a stubborn credit card balance. Path 1. The lump sum. They borrow the full £30,000 at once, at a typical rate of 6.2%. That single withdrawal pushes their savings over the pension credit disregard and wipes out roughly £75 a week in support. Over 10 years, that is close to £39,000 in benefits they no longer receive, gone before the interest on the loan has even finished compounding. Path 2. The drawdown facility. They take £10,000 now and agree to draw the remaining £20,000 in stages, starting with another £10,000 the following year. Because the untouched portion is not counted as savings, they keep their full pension credit. The catch is the interest rate on a drawdown facility usually runs about 0.5% higher than the rate on a straight lump sum. So which one actually wins? Keeping roughly £3,900 a year in pension credit against paying perhaps £150 a year in extra interest on the unused portion is not a close call. The drawdown route wins by a wide margin. Rates on equity release in 2026 typically run somewhere between 6.1% and 6.8%, depending on how much of the home's value you are borrowing against, so the exact figures will shift a little from lender to lender, but the shape of the comparison holds. This is the kind of maths a good advisor should walk you through automatically. Not every one of them does, because a lump sum is simpler to arrange and pays the same commission either way. Ask directly whether a drawdown facility is available before you agree to anything, because the question alone tends to change the conversation. Even once David and Susan get this part right, there is a third rule waiting for them, one that only shows up if they ever need to sell that Bristol home to pay for care. Most people know their main home is free of capital gains tax when they sell it. That relief, private residence relief, is real, and it covers you for the entire time you actually live there. The part almost nobody knows is what happens the moment you move out before the sale completes. HMRC gives you a grace period called the final period exemption, and it covers 9 months from the day you move out to the day the sale completes. Sell within that window and you are still fully covered. Miss it even by a matter of weeks, and capital gains tax becomes due on however much the property grew in value during the extra time it sat on the market. That 9-month window used to feel generous. It does not anymore. Average time to sell a home in the UK has stretched to around 182 days in this higher interest rate cycle, and for houses being sold out of a deceased or incapacitated owner's estate, sales tied up in probate or care arrangements, that figure regularly passes 300 days. The 9-month allowance works out to roughly 274 days. A slow sale on an ordinary family home can miss that deadline without anyone doing anything wrong. There is a wider exemption if the move is into a care home specifically, stretching the window to 36 months instead of 9. That helps, but it creates a second problem nobody warns you about. If one spouse moves into care and the other stays living in the house, the exemption calculation gets complicated because the property is still someone's main residence the entire time, and the rules that apply to a jointly owned home are not the same as the rules for a home owned by one person alone. My neighbour in Surrey went through almost exactly this. His mother moved into a nursing home, and it took him 14 months to sell her flat, longer than he expected, in a slow patch for the local market. He assumed the care home exemption simply covered him. It did not, because he missed a filing deadline tied to reporting the gain, not just the exemption window itself, and HMRC sent him a bill for £12,000. 3 traps so far. A frozen inheritance tax threshold that now includes your pension. A benefit system that punishes accessible cash. A capital gains window that is easy to miss without meaning to. None of this is designed to make anyone feel like they are constantly checking over their shoulder, and there are 3 specific moves that deal with all of it. Moves that work for a normal homeowner, not a millionaire with a team of accountants. Before the 3 moves, one honest word about how this feels. A lot of people hear inheritance tax and something in them tightens because you paid income tax on the way in, you paid stamp duty when you bought the house, and now the government wants a third bite when you die. That reaction is completely normal. You worked for 40 years, and it can feel like the goalposts keep sliding sideways every time you finally get close to them. The instinct that reaction produces, though, hiding money, moving it to a relative's account, not declaring something, is the fastest route to an HMRC inquiry, not the slowest. So set that instinct aside. What actually works is quieter than that, and it is available to anyone with a normal estate, not just people with accountants on retainer. First, use your ISA allowance while it is still whole. In the current tax year you can shelter £20,000, and if you are under 65, that number falls to £12,000 from the 6th of April 2027. Money inside an I still counts toward inheritance tax, but moving idle savings into one before that date locks in the larger shelter for growth while it is still on offer. Second, look at your tax-free pension lump sum while your estate sits close to that £500,000 line. You can normally take up to £268,275 tax-free from your pension. If your estate is already over the threshold, gifting some of that lump sum now, rather than leaving it inside the pension, starts the 7-year clock on a potentially exempt transfer before the 2027 pension rules pull the rest of your pot into your estate. Third, check how your house is legally owned. If you and your spouse hold the property as tenants in common rather than joint tenants, each of you can use your own nil rate band and residence nil rate band separately, which matters far more once pensions are added to the estate calculation. A solicitor can normally convert this in a matter of weeks for a modest fixed fee. Here is the plainest way to see why timing matters. Money sitting in an ordinary savings account is fully counted both for means-tested benefits and eventually for inheritance tax. The same money moved into a cash ISA before the allowance shrinks is still yours, still working, but now it is sitting inside a shelter instead of out in the open. If you want this as an actual framework to bring into your next conversation with a solicitor, rather than something you half remember, that is exactly what staying subscribed to this channel gives you, because these HMRC and DWP thresholds keep shifting and someone needs to track the dates for you. We have covered 3 specific traps today: a frozen £500,000 inheritance tax threshold that is about to pull your pension in with it, a benefit system that treats accessible equity release cash very differently from money sitting in an untouched facility, and a 9-month capital gains window that closes faster than most house sales actually take. None of this exists to take your home away from you. The rules are not designed to make you homeless or to punish you for owning a house and saving into a pension. They are designed to quietly collect revenue from people who set up their finances years ago and never went back to check whether the thresholds around them had moved. Knowing the 6th of April, 2027 date, and knowing that £10,000 figure the DWP uses is what moves you from being exposed by accident to being protected on purpose. None of it requires a complicated trust or an expensive scheme, just a clear look at where your numbers actually sit today, and a willingness to make a few changes while there is still time on the clock. Retirement is not only about how much you manage to save, it is about how much of that you are actually allowed to keep. I'm Arthur, and I'll see you in the next guide.